Welcome to Fear and Greed, business news you can use today. With just a month to go before the end of the year, the local share market is one of the worst performing major bourses for 2025. National home values record a third consecutive monthly rise in price of 1%, and the tax office to crack down on high-income professionals and tradies. Plus, the federal government's Help to Buy scheme kicks off this week, and new research shows that cats meow louder at men because they don't listen as much. It's Monday, the 1st of December 2025. I'm Michael Thompson, and good morning, Sean Aylmer.
That's the men, not the cats, not listening.
Important to clarify that one. We'll get to that a bit later on, Sean. The main story this morning, with 1 month to go before the end of the year, we are officially into December, the local share market sits at the bottom of the global league tables when it comes to performance, with the S&P ASX 200 up just 5% in the first 11 months of 2025.
That compares to more than 20% in Canada and Japan, 16% in Britain and Germany, 12 to 14% or so for the major indices in the US and China, and about 11% for Europe. There are a number of reasons why the local market has underperformed. The first is that the Australian market is overweight banks and financials, and the major lenders, particularly Commonwealth Bank, have underperformed this year. On Friday, Commonwealth Bank closed lower than where it started 2025. Pretty remarkable to think about that. Also, our biggest mining stocks are the iron ore producers, not really a forward-looking commodity. Generally, the best performing sectors globally have been tech and new economy businesses. That's not really Australia's strong suit. A second reason for the underperformance is the record flow of money into overseas-focused exchange-traded funds. ETFs are an easy way to invest offshore, and local investors have been taking advantage. Only 5 of the top 20 ETFs in Australia this year are focused on the Australian share market. A third reason is that US President Donald Trump has dialed back the rhetoric on trade wars and tariffs. Larger economies and share markets have responded. And a fourth one is that while interest rates in Australia now seem to be on hold, US rates are expected to fall this month. Lower interest rates theoretically improves earnings. That makes, in this instance, US companies more attractive.
Okay, so it's based on the sectors. It's based on ETFs. It's based on Donald Trump and trade. It's based on interest rates. That's why, Sean, I'm going to ask you the harder part now. Is it going to continue? The Australian underperformance, are we going to see that continue through to the end of the year and perhaps beyond?
Yes. I mean, I don't know the answer. It probably really comes down to what happens to the tech sector on Wall Street. AMP Shane Oliver said share markets broadly remain at risk of a further correction given stretched valuations, risks around US tariffs and the softening US jobs market. But with the Fed still likely to cut rates further, shares are likely to provide reasonable gains on a 6 to 12 month horizon. That should help the Australian share market, even though the Reserve Bank's done with cutting rates. The stretched valuations is a big risk, though. UBS's equity strategist, Richard Shellback, reckons the ASX 200 will finish next year about 3% higher than where it is today on the back of a strong mining sector. Now, that's not a particularly strong performance if that's what comes to pass. Other investment banks like Goldman's have forecasted over the longer term Wall Street will underperform other global indices. Just the fact that Australia has underperformed means that its baseline for the next 12 months isn't as high as the others. As I said, I don't know, Michael, I'm talking in circles here, but certainly the local market has had a poor 2025 relative to its peers. Not good for local investors, of course, including everyone with super shares.
Yeah, good point. It's also worth reminding everyone to get professional advice when making investment decisions. Always very helpful.
Always.
Just before we leave local markets, how did things finish up on Friday? Not just for the week, really, but for the whole month.
Yeah, so the S&P ASX 200 finished the month at 8,614 points, flat on Friday, up 1.5% for the week. But for the month of November, it lost 3%. The worst since March. Futures trading suggests the market will open a little higher this morning.
What about Wall Street?
It was fairly quiet over the weekend, really. We had Thanksgiving Day on Thursday, so not a lot going on. In commodity markets, oil's trading around $63 a barrel. Gold's back up to $42.17 an ounce. The price of the precious metal has risen on the back of expectations of rate cuts in the US. Silver hit a new high over the weekend, over $56 an ounce. That's amid mounting supply concerns. And the Aussie dollar, Michael, 65.5 US cents.
All right, let's take a look at property now, Sean, because national home values across the country rose by 1% during November. That is the third consecutive month of strong growth.
The mid-sized capitals outperformed, with Perth up 2.4% during the month. Sydney came in at 0.5%, Melbourne 0.3%, according to Cotality. All other capital cities outside Sydney and Melbourne were up at least 1%. Now, the bias towards the mid-sized capitals in part reflects a lack of listings. The national average is 16% below average. That's the national average of listings. In average, it's just 2% below the long-term average. So that does explain some of the reason why those mid-sized capitals are outperforming. It doesn't really explain the Melbourne result, though. After 3 straight months of strong growth, affordability pressures and a lack of further interest rate cuts loom as dampeners on future growth as we go forward. Cotality's Tim Lawless said the subtle easing, and it is very subtle, in the headline result last month comes as auction clearance rates have tracked lower. So, for example, the national result over the weekend was 68.2%. That's the preliminary clearance rate. Now, the decade-long average is actually higher than that. The spring average is much higher than that, so it does look like the oomph is coming out of the market. Brisbane, worth a mention. Median value now over $1 million. Sydney leads the way at nearly 1.3 million. Melbourne, 823,000.
Okay, we've covered a lot already. We've still got a lot more to go. We'll be back in a moment with the rest of the day's business news. Sean, the tax office will crack down on high-income professionals and tradies who pursue aggressive tax evasion strategies by splitting income with their spouses and children.
The ATO has identified elevated levels of excessive income splitting by people who use trusts, companies, and partnerships to divert income to family members on lower tax rates. It's issued updated guidance that spells out exactly what it will allow when it applies the anti-avoidance measures to so-called professional service income. Now, that captures not just doctors, lawyers, architects, IT professionals, but all professionals and skilled tradespersons. So, electricians, plumbers, they're going to be looked at by the ATO as well. A personal service business is basically any operation where most of the money made is generated by personal skill, labour or expertise. Podcasting, perhaps?
Maybe.
The action is likely to affect many thousands of personal service businesses that use an income-splitting strategy. Worth noting, the ATO won't backdate its compliance push in that if taxpayers make a genuine attempt to move their arrangements into low risk by June 30, 2027, the tax office is unlikely to take compliance actions.
I suspect there'll be a few people calling their accountants now after hearing
Yeah,
this.
very possibly.
We talked about house prices before, Sean, and the federal government's Help to Buy scheme kicks off this week, whereby first home buyers can share equity in their homes with the government to basically help them to get into the market sooner, purchase the property earlier.
Yeah, the program will provide 10,000 low to medium income first home buyers each year the ability to purchase a home with just a 2% deposit. The government will contribute 30 to 40% of a home's price in exchange for equity, which the owner can buy out later. While the government said it won't put pressure on prices, it is a demand-side policy, fellas, not a supply-side policy. So it's hard to see that it won't put pressure on prices, especially at that bottom end. The government's 5% deposit scheme, for example, is a demand-side policy. It's coincided with an increase in home prices at that end of the market. Don't see why this one won't. Anyway, we'll see.
Yes, does seem perhaps a little optimistic. The federal budget deficit has widened to $32.9 billion in the financial year to October, up from the $10 billion deficit recorded for the full 2025 financial year.
Yes, though the deficit is $7 billion better than Treasury had forecast for this time last year, according to the Department of Finance. Taxation revenue was about $4.6 billion more than expected. Total receipts, $8 billion higher. Now, government payments were also a bit higher, driven partly by higher wage and salaries bill, which reached $10.4 billion. Government spending as a percent of GDP remains at post-World War II highs. That's probably about as good a way as judging it versus history. So spending as a percent of GDP, World War II high. Federal Treasurer Jim Chalmers has said the economy is shifting away from public spending towards private sector spending, though we're not really seeing it in the numbers yet.
It's a massive week for the economy, isn't it, Sean?
It is.
I'm excited. It's got economic growth figures due for release on Wednesday. I realise when I say that it sounds sarcastic. I'm genuinely excited, and we discussed this today in the week ahead with the Kook. Yeah,
he's excited. He loves a week like this, the Kook.
Yeah. And it's Wednesday, we've also got the house price data out today. We've got a bunch of other things, and it is just the headline is the GDP figure, but there's so much more going on.
It'll give a very good insight into just how much better the economy was travelling in the September quarter. Consensus seems to be for 2.5% annualised rate of growth. That's actually not too bad. You'd like it to be a bit higher, but it's not that far off trend. There are also business indicators, building approvals data out today and tomorrow. After last week's inflation data for October, of course, see chances of another rate cut. Miserly chance of a rate cut.
Yeah. It's worth listening to the Kook, Stephen Koukoulas, who is our resident economist, because he just explains all the pieces that go into the GDP and the impact of last week's data, the surprise jump in inflation, capital expenditure, and all of those pieces, how they feed in. It's a great explainer. Yeah, I think that's why it's valuable as well, that if you've ever kind of not been quite sure and haven't been perhaps a bit too afraid to ask someone, I'm not afraid to admit what I don't know. And so the Kook explains it all. It's coming up after the show. ASX listed corporate travel management, Sean, is in a world of pain, with the company saying it has to reverse £80 million of revenue related to UK customer contracts. That's got to hurt.
So corporate travel management failed to release its half-year accounts in August. Its trading has been suspended ever since. The company has said that restatements, presumably of revenue and earnings, might be required. It also withdrew guidance for its European business, which it said was performing above targets. Now, on Friday, corporate travel management said the chief executive for the UK and Europe has been stood down with immediate effect. The company still doesn't know when it will be able to release its annual accounts. Media reports suggest that corporate travel management basically overcharged UK customers. That's the allegation anyway, including the British government. Not a good look for the company.
No. Turning to international news now, and Canadian Prime Minister Mark Carney has unveiled a sweeping energy plan with the province of Alberta that paves the way for a new oil pipeline, a massive carbon capture project, and the construction of nuclear power for data centres.
The plan is aimed at reducing Canada's economic dependence on the US and is meant to, I quote, unlock the full potential of Alberta's energy resources while creating hundreds of thousands of new high-paying careers for Canadians, according to the PM's office. Carney said Canada's tight interdependence with the US, once a strength, is now a weakness, according to Bloomberg. Canada shipped more than 95% of its energy exports to its neighbour last year before Donald Trump began slapping tariffs on Canadian goods. I quote Carney, "This is a rupture, not a transition, which means our economic strategy needs to change dramatically and rapidly. Nostalgia is not a strategy. The US has changed. That's their right. We must respond. That's our imperative."
Wow.
Real leadership from Mark Carney there.
Yeah, it seems to be. To go from that, Sean, to this next story, it's quite the transition, really. Last week, we had the story about most dogs descending from wolves. They'd done that kind of study of genes. It feels only fair to balance things up and have a cat story this week. And researchers have found that cats meow more frequently when greeting male caregivers, probably because men don't listen as well.
Do you sometimes wonder, are there a bunch of scientists sitting around a room thinking, what's going to be some really weird stuff we can come up with? And this could be it.
Yeah, what's going to get people on a podcast in Australia talking about?
Talking about it.
This one.
Yeah. So the study in the journal Ethology filmed inside cat owners' homes. Now, one of the big reasons we know a lot more about dogs than cats is a practical one. You bring a dog into a laboratory and watch it behave without a lead on. You can't do that with a cat. It's simple as that. I mean, you can, but they're they're just different creatures, clearly. Anyway, the study found that the cats meow more when men enter a room. And this is in a report in the New York Times. Across all demographic variables, so including the sex, age of the cat, pedigree status, number of cats in the home, only one factor was linked to vocalization frequency: the biological sex of the caregiver. And on average, cats produced 4.3 meows in the first 100 seconds of a male caregiver getting home, compared to 1.8 with women. The team at Bilkent University in Turkey hypothesised that men require more explicit vocalisations to notice and respond to the needs of their cats. In other words, men don't listen as much, cats adjust their behaviour accordingly.
Can you imagine being the researchers going to ask for a grant to study that? We've got a theory. We want to check it out. Can we have a couple of $100,000 for this experiment on cats? Yep, go for it. That is pretty extraordinary. I love that. Up next is Fear and Greed Q&A. I mentioned this before. Stephen Koukoulas, our resident economist, and it's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 1st of December, 2025. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.